Some families have been wealthy for 200 years. That is not a coincidence. The Rockefellers, the Rothschilds, the Astors, their fortunes survive wars, economic crises, and generations. There is a well-known saying in financial circles: the first generation builds, the second enjoys, and the third loses everything. But certain families have broken that cycle for centuries. Their secret weapon comes down to two words: the trust fund. Today, we open that vault. 10 precise, concrete strategies used by the greatest dynasties in the world. This is not legal theory. These are the exact mechanisms that protect billions of dollars across generations. Strategy number 1. The dynasty trust. A classic inheritance looks like a suitcase full of cash. The moment it is handed over, it can be spent, taxed, or lost. A dynasty trust works differently. The assets, real estate, stocks, businesses, legally belong to the trust, not to any individual. The founder sets the rules. Children, grandchildren, and great-grandchildren receive distributions, never the full capital. These distributions can be conditional: funding education, covering medical care, or supporting a business venture. Here is the key point. Beneficiaries never directly own the assets. So when they die, those assets are not part of their personal estate. No inheritance tax applies. In the United States, that tax reaches 40%. In 2 generations, a fortune can be cut in half. The dynasty trust bypasses that mechanism entirely. The capital keeps growing decade after decade without interruption. John D. Rockefeller set up his first trusts in the early 20th century. His fortune is still active today. These trusts are never managed by a family member. Emotions and money are a terrible mix. A professional bank or trust company is appointed as trustee. It has a legal obligation to follow the trust's rules precisely. No impulsive heir can override an independent trustee's decision. The system is built to last, not to please. Strategy number 2. The legal shield. A surgeon inherits $5 million placed directly into her account. She is then sued for a medical error. Those $5 million are immediately seizable. A court can award them to the plaintiff within months. Now imagine the same situation with an irrevocable trust. That money is not in her name. It belongs to the trust. Her creditors cannot touch it. It is a legal wall between her career and the family's wealth. This shield also works against divorce. Assets inherited through an irrevocable trust are generally treated as separate property. The trust existed before the marriage. In case of separation, the spouse has no claim on those assets. It is an automatic prenuptial agreement, valid for every generation of the family. Strategy number 3. Controlling the heirs. Old money families have a deep fear that their heirs will waste everything. They created 2 powerful tools to prevent it: the spendthrift clause and the incentive trust. A spendthrift trust prevents the heir from freely accessing the capital. The trustee pays a fixed amount each month, like a salary. The heir cannot borrow against the trust or sell their future rights to it. They are protected from their own worst decisions. If that heir racks up significant debt, creditors cannot claim the trust. They do not directly control the funds. The incentive trust goes even further. It ties payments to specific behaviors. A grandchild receives $200,000 when they earn their university degree. The trust matches every dollar they earn from a real job. The trust can fund a business, but only after the trustee approves a solid business plan. Other clauses can include regular community service, staying out of debt, or even quitting smoking. The founder continues guiding their family decades after their death. The trust is their living testament. This is not free money. It is a tool for building character. Strategy number 4. Avoiding taxes legally. Taxes are not just an inconvenience for the ultra-wealthy. They are a force capable of destroying a fortune in 3 generations. In 2025, the U.S. federal exemption on gifts and estates is $13.99 million per person. An old money family places exactly that amount into an irrevocable trust as early as possible. If that sum grows to $100 million over 50 years, those $100 million escape estate tax entirely. There is also a specific tax-targeting transfers that skip generations, called the GST tax. It is designed to tax fortunes passed directly to grandchildren. But there is an identical exemption. A well-structured dynasty trust uses it in full. The most overlooked tool is the Irrevocable Life Insurance Trust, or ILIT. A $20 million life insurance policy can generate an $8 million tax bill. With ILIT, the trust owns the policy, not the individual. When they die, the $20 million goes directly to the trust, completely tax-free. That money can then pay other taxes or feed back into the family dynasty trust. Strategy number 5. Total confidentiality. When someone dies without a trust, their will is filed with the probate court. It becomes a public document. Anyone can look up the list of assets, bank accounts, properties, and named heirs. That attracts journalists, distant relatives, and professional scammers. The process can drag on for months and cost hundreds of thousands of dollars. A living trust avoids all of that. When the founder dies, the trust continues without any court involvement. The successor trustee simply steps in. No court filing, no public record, no information leak. For old money families, discretion is not a preference. It is a fundamental security measure. The less the world knows about their assets, the less exposed they are to lawsuits, scams, and physical threats. A will is a public announcement. A trust is a private memo. Strategy number 6. Running the fortune like a business. When a fortune spreads across dozens of heirs, it becomes unmanageable. Family conflicts can destroy what generations built. The solution is to professionalize the management. The trust becomes a corporate structure, not a shared family account. A corporate trustee is appointed, a bank or specialized firm. It has teams of lawyers, accountants, and investment managers. That trustee can say no to an irresponsible heir by simply pointing to the trust's rules. There is no family argument, just procedure. The wealthiest families go even further. They create their own private trust company. That company is dedicated exclusively to the family. Its board combines senior family members and independent experts. This structure is often called a family office. It centralizes taxes, estate planning, investments, and philanthropy. Rockefeller Financial Services was founded precisely to manage the family's assets. That model is now standard for billionaire dynasties. Strategy number 7. Accessing investments reserved for the ultra-wealthy. A trust worth $500 million plays in a completely different league. It can write checks that most investors will never sign. Private equity in non-listed private companies. Venture capital funds backing the next major tech breakthrough. Hedge funds with strategies capable of generating profit even in a down market. Commercial real estate with assets worth hundreds of millions. Farmland and timberland managed as inflation-protected stores of value. These investments are often illiquid. It can take 10 years to see a return. For an individual investor, that is a major risk. For a dynasty trust built to last a century, it is a massive competitive advantage. The trust can afford to be patient. Patience is the weapon that turns millionaires into billionaires. Diversification is also extreme. Stocks, bonds, real assets, alternative funds, multiple countries, multiple currencies. When one sector collapses, another part of the portfolio compensates. The capital stays stable and keeps compounding. Strategy number 8. Philanthropy as a financial tool. Carnegie, Ford, Rockefeller. These names are carved onto museums and universities around the world. That is not a coincidence. Philanthropy is both a moral act and an extremely effective tax strategy. The charitable remainder trust allows the sale of an appreciated asset, such as real estate or a stock portfolio, without paying capital gains tax. The asset is first transferred to the trust. The trust sells it tax-free. The founder then receives annual income for up to 20 years. At the end of that period, the remaining balance goes to a charity chosen in advance, and a significant tax deduction is granted from the start. The charitable lead trust works in reverse. The trust first pays a charity for 10 years, then the remaining assets pass to the heirs. By leading with charity, the taxable value of the transfer to heirs is dramatically reduced. It is a legal way to pass massive fortunes with very little tax. The Permanent Family Foundation is the ultimate step. The Rockefeller Foundation is the perfect example. Junior family members sit on the board of directors. They learn management, finance, and social issues from a young age. The foundation unites the family around a shared mission. They are no longer just a wealthy family. They are an institution. Strategy number 9. Preparing heirs from childhood. All the legal structures in the world are useless if the heirs are not ready. Old money families understand this. Their most valuable asset is not their assets. It is their children. Education starts very early. The values, frugality, hard work, and discretion are passed down like a family religion. Children hear the story of the founder, how the fortune was built, what sacrifices were made. They understand they are temporary guardians, not owners. In adolescence, the education becomes structured, regular family meetings with professional advisors. Young members learn to read a balance sheet. They understand the trust's assets and the family's charitable mission. Some trusts even include a personal letter from the founder, a moral guide on the family's philosophy and hopes for the future. For family businesses, the shares are placed in a dedicated trust. Leadership goes to the most qualified heir, not the oldest. Other heirs receive income without interfering in operations. Money and power are separated. Some young heirs receive a small starter trust to manage themselves with an advisor. It is a training ground for learning to invest before handling larger sums. The goal is not to create idle heirs, it is to build responsible and capable stewards. Strategy number 10. The mindset that makes everything work. Legal structures are the armor, but without discipline, they are useless. The old money mindset rests on 3 pillars: discretion, frugality, and long-term thinking. This is called stealth wealth. No flashy sports car, no visible logo, no display of excess. Showing off wealth attracts the wrong attention and wastes capital that should be compounding for the next generation. This is not about being cheap. It is calculated. Spend on what lasts: a quality education, a solid home, a timeless piece of art. Avoid what loses value: luxury gadgets, fleeting trends, and status spending. The family's lifestyle never grows faster than the trust's investments. That is a rule of patrimonial survival. The permanent surplus generated by that discipline is reinvested. It feeds the compounding machine for the next generation. The most important shift in perspective is this one. They do not see themselves as owners of the fortune. They see themselves as stewards. Their mission is to preserve and grow the wealth, just as their parents did before them. They are not investing for next quarter. They are investing for the next century. Those are the 10 strategies of old money dynasties. The dynasty trust as a permanent foundation. The legal shield against lawsuits and divorce. Spendthrift clauses and incentive trusts to guide heirs. Legal tax optimization through exemptions and insurance trusts. Absolute confidentiality by avoiding public probate. Professional management through family offices. Access to alternative investments reserved for the very largest fortunes. Philanthropy as a fiscal and moral tool. Financial education passed down from childhood. And finally, the steward mindset rather than the consumer mindset. You may not need a $100 million trust to apply these principles. Thinking long-term, protecting your assets, living below your means, and teaching solid financial values to your children. These are universal truths, and they can transform any level of wealth into something that lasts. A trust fund is not just a legal document for the rich. It is the concrete expression of a vision of foresight, discipline, and legacy. And that is a lesson worth more than any fortune.